Hello, you are safe, soft, and warm with KIO Macro coming at you live with Jay Manchin and Isaac the Ship Newton. How are you guys? No, I'm just playing. How you guys doing today?
I'm good, man. How you doing?
JT swallowed some helium today. Isaac, how you doing, man?
This just in. Isaac's doing great. Is that the voice we're going with?
You almost had me spit out my smoothie. I'm like, man, I know Isaac's gonna try to do some kind of voice. I just didn't know what it was.
There we go. There we go. It's the Mid-Atlantic. The this just in. Bullenberg has fallen down. Oh, the humanity. You know, like that, like old timey, like radio accent.
Why did guys sound like that back in the day? It's like, was that like the cool voice?
It's just the cool voice.
You just had to be there, I guess. Imagine that's the voice of girls. Hey, baby, how you doing? You want to come over? Oh my gosh, sure.
This just in. I'm on my way over to your house. Yeah, that'd be wild.
All right, man. Let's get into it.
Why did they say that even? That's just it.
Well, because he's like an announcer, you know. Everything's breaking news to him.
Oh my goodness.
All right, guys, let's jump into it. So today we're going to be covering the macro per usual. We're going to look at some Bitcoin ETF data per usual. We're going to see if we're in an altcoin season right now. You know, I'm sure you guys have seen some of these altcoins. They've been pumping. A lot of people think that altcoin season is here. You guys have heard us saying that, or at least heard me saying that we're expecting one more correction within crypto. I'm going to show you guys a piece of data that confirms that a little bit more for me. And Isaac's going to cover Amara's law. Yeah, he's going to cover a cool law that's going to help you with your investment filter.
We also have Jay Powell yesterday. He did a 60 minutes. So we're going to discuss that. NYCB, which stock has plunged 40% last week in one day. The job numbers were crazy on Friday as well. So we kind of got a lot to get into.
Let's jump into it, guys. All right, guys. So you guys have saw us bring this up for the past 3 or 4 episodes. And it's important because people been expecting the Bitcoin ETF to get approved pretty much for the past year. You got to keep in mind, the market isn't as patient a market as we may seem. I feel like people have been patient with the ETF. They're trying to give it time to, perform well. Even though it's the best performing launch ETF in history, it still didn't do as well as most people think. And I feel like most people aren't looking at the data correctly. So, while we do think the ETF is going to go on and do great things, the topic of this discussion right now is like, hey, is this enough to cause a bull market? This is the narrative that we've been hoping for. And now that it's here, we just want to assess it. So as you can see here, ever since the ETF launched, we've only seen a net. And when I say net, I mean institutions who did not have exposure to Bitcoin beforehand, or people who didn't have exposure to Bitcoin beforehand, 36,404 Bitcoin. And the reason why that's the actual number, and you see this is the outflow, 144,246. People have been selling their GBTC, their grayscale, and they're cycling it into the other ETFs because the annual management fee is cheaper. Versus paying $1.50, you can pay as little as 0.25, which is much, much cheaper. So people are taking that into account when they look at the volume, like, oh, it's been 144 plus 1,000 Bitcoin in volume. That's just the volume being cycled out. So I'm not expecting things to just change overnight, but if this trend doesn't start to flip a little green here, I wouldn't be surprised if we saw Bitcoin correct a little more. So that's the first thing. I'm just going to go through these real quick. Everything is pretty much looking the same. Gold's consolidating. You have the S&P hitting another all-time high. You got the Dow hitting another all-time high. You got the NASDAQ about to hit another all-time high. And you got Apple near all-time high levels. Looks like it's consolidating there, and that looks like it's setting up to be like a strong support level, but only time will tell. And then we have Bitcoin at around 42K, and we're on the monthly chart here. So you can see the last month was a pretty, I'm not going to say flat month, but you see that candle. Normally when you see candles with like long wicks like that, correction usually ensues afterwards. Like you see this one here, You see this one here, but this one was to the upside. You see these long wicks. You see these long wicks. If we go down to the weekly, you can see that we've kind of just been consolidating at this area. Now, this could be a good thing. And if we hold this level, that's only going to be better for Bitcoin. But if we drop below this trend line and we start to go below these levels, no matter what, I still think that, I'm not going to say no matter what. As far as the data that I'm looking at, I still think we're going to see a correction. All the charts are pretty much looking the same. We're not seeing an increase in stablecoin liquidity, or we're seeing an increase in stablecoin dominance, which means people are selling crypto and getting into stablecoins. That trend's the same with USDC. It's the same with USDT. And then now let's talk about, like, are we in an altcoin season? So if we look at the altcoin season index, this is on blockchaincenter.net. And if you scroll up here, you can choose to look at it from a monthly or a yearly time frame. Now, if we go back to May of 2021, as well as November of 2021, that was when we saw pretty much the blow off top. You saw we were above this line here in May 2021, and then things dropped. And then November of 2021, we were above this line as well. So look at where we are right now. That doesn't look like an altcoin season to me. And while we have called out a few projects on this channel, such as Pendle Finance and a few others, there have been some projects that's been outperforming Bitcoin, but for the most part, most altcoins are underperforming Bitcoin. Okay, and then also, if you look at this chart here, we're going to look at this on the daily just so we can see it a little better. This is the total crypto market cap, excluding Bitcoin and Ethereum. Now, this is a downtrend. It's trending downwards. It's creating lower highs and lower lows. You have a high here, and then the high here that's lower. You have a low here that's lower, and same here and same here. If we get below our 62 EMA and we come back and retest it as resistance, well, that means that we're probably going to go to our 200-day moving average, because that's the next major area of support around this level right here. But if we can hold on to this level, then, you know, we'll see what happens. But like I said, I still think we have one more correction to go. So that's how we're looking at markets. JT, I know you've been looking at the Fed data, and I know we had a 60-minute interview and some new data came out at the end of the week / weekend. What are you looking at, man? What's your thoughts on the market and the data that you interpreted?
So yeah, I'll kind of start backwards here. I'll start with what happened on Sunday. So Jay Powell had a 60-minute interview. Now, shocker, there wasn't anything new. It is Jay Powell, so it's not much you would expect. But he did say a couple of things that caught my attention. So he was asked about the commercial real estate potential crisis, and long story short, you know, he sees it as a manageable issue for banks. And we know that 70% of CRE loans are held by regional banks. So he sees that as a manageable issue for regional banks, which is where, and you'll see why in a sec. He also said notably that data doesn't need to be better. It just needs to be sustained. And so he's willing to accept slightly worse data to basically, and this is regarding cutting rates. So he doesn't think we'll have enough data by March to determine a directional decision regarding interest rates. But he's saying that the data could come out slightly worse and they could still end up cutting rates sometime in June, or let's say middle of the year. That's pretty much what he indicated, middle of the year. So he doubled down on not getting a rate cut in March. And then he also, usually he tries to not ever, any Federal Reserve chairman tries to never really talk about the fiscal side of things. But he also noted that we're on an unsustainable path fiscally. And we all knew that. But I thought that was interesting because, like I said before, they try their best to, every time they're asked about anything regarding fiscal policy, they basically flip their nose up and say, that has nothing to do with us. We don't want to comment on that. It'll overcomplicate things, right? And so he did note that. And it's probably because it's making his job a lot harder. And so he probably had to note it because they try their best to stray away from it. But inevitably, fiscal policy, especially the path we're on, inevitably affects monetary policy. So I feel like he's in a position to where he has to try to mention it in some way. So nothing new in the 60 minutes. Like I said, just a few notable things that he said there. Now, the reason why his commercial real estate comment was interesting, because last week, NYCB, New York Community Bank, their stock plunged 40%, 42% or something like that in a day. And the reason why is because they cut dividends and they're basically like increasing the capital they have on hand. And the reason why is real estate. That's what they cited, right? And so my assumption through that is they're buffering at this point because they know that the loans that they have coming due, they're going to be upside down essentially. So they have basically unrealized losses at this point, and they're gearing up to buffer against that maturing loan or those maturing loans that they have. Now you can look up and see what exact properties they have in their portfolio. I haven't done that, but you can look that up. So and it's multifamily specifically, by the way, that's what they cited. And so to say that it's a manageable issue, I don't know if we'll see every small bank handle it in the way that New York Community Bank is handling it. They're still going to be here. It seems like they're taking the proper steps to buffer against that potential downfall. But do you think every small bank that has a large commercial real estate holding is going to handle it the same? Most likely not. And so I do see, I guess, more potential troubles in the commercial real estate market, in addition to us being oversupplied in that market. And so we shall see. We shall see. Moving on. On Friday, the job numbers came out. Non-farm payrolls came out. There was 353,000 jobs added. The expectation was 185,000. So it blew it out the fucking water, right? This is in addition to December's jobs numbers getting revised up, not down. Remember, every revision was down before. This was revised up by 129,000 jobs to like what was it? I got it written down somewhere up in here, like 333,000. And so the labor market is still looking way too damn strong, man. It's looking way too damn strong. And so 289,000 of those jobs were added in the service sector, by the way. And so that only adds to the sticky inflation in the service sector. So that'll lead to more inflation or more sticky inflation in the service sector. Although it's going to be more sticky in the service sector, you can see here, I've been watching Truflation for I don't know how long now, but you can see it's sitting at 1.4%. 2 days ago, it was at like 1.35, right? And so it's been fluctuating between essentially 1.5% to 2%, and it dropped below that for a minute. And so you can say, once again, that the Fed, although we may have sticky service inflation, and so you may see higher or more elevated PCE numbers based on the actual inflation rate, they've accomplished their goal in the short term. And at this point, we're just on a path of seeing if we could sustain it. Unemployment sitting at a good rate as well at 3.7, and wages are outpacing inflation at 4.5%. And so, I mean, things are looking pretty good. And so while I'm still inherently in the camp that we're going to see some type of correction, even after today, as you pointed out, markets they didn't close, but they hit all-time highs. Tech and like healthcare, I think it was. And so although they hit all-time highs, I'm still in the recession camp inherently. There is not a piece of data though that I can point to, and I've been looking. There's not a piece of data that I can point to that points to a recession at this point. Yeah, there are idiosyncratic things that happen that could be potential woes, but no data point that would usually be recessionary, including manufacturing, is looking recessionary at this point.
What about the yield curve inversion?
I was watching Austin Goolsbee. He's one of the Fed governors. He just became a Fed governor a few months ago. I was watching him speak on Bloomberg, actually, and they were talking about the inverted yield curve here. And he brought up an interesting point. And so he was saying, yield curves would predict a recession in normal times, meaning if a potential recession was being caused by demand side issues, essentially. But because the demand side is there and we're seeing the supply side recover and it's bringing inflation down, the yield curve inversion is not predicting a recession. It's a reflection of investor sentiment on what the Fed is going to do. Mm-hmm. And so I thought that was an interesting point because I've never heard that before. And so that's something to think about.
A wise baby once said, just because it makes sense doesn't mean it's true.
Yeah, I said that when I was 2. That's true.
That is interesting.
Yeah, and yeah, man, as you know, guys, we made a video on this already. They held rates steady last week. So we'll see at the next meeting what happens, but I doubt it's a rate cut in March. And what that means for your investment portfolio, I guess Isaac will help close this out by teaching us something new, for one. And for two, it'll help give us more direction.
Do I start?
Yeah.
Oh, okay. Yeah, cool. Thank you, JT. That was
You're
fast.
welcome. No, I'm
That
joking.
was really interesting. Thank you. Now, a lot of you guys in the comments have been wondering, oh my gosh, what is the Amara's law? Like I've been seeing this constantly. What is Amara's law? What does it mean, Isaac? Can you please explain this to us? So we decided to, hey, give the people what they want. We're going to explain Amara's law. Now, why am I talking about Amara's law? Basically, in my work, we've been looking at this law because it explains a lot of how psyche works in policy, but it also explains a lot about how investment decisions are made. The law comes from a young chap back in the 60s named Roy Amara, and he's a Stanford graduate. Was it Stanford computer scientist? And he coined the idea that, or is really just an observation. It's not a law. It's more like an observation that after an initial innovation is announced, you'll usually see a lot of speculation about the achievements that this innovation will lead to. And this creates what is called the hype train, or he calls it peak of inflated expectations, but it's hype. It gets hyped up. The reason for this is because when nothing's been delivered on an innovation, all you have is speculation devoid or detached from reality. And speculation detached from reality often leads to inflated expectations. Then once the technology is, being tested further, more news is being brought out from it. This could even still be before it's released. You then get initial, oh, this is not meeting my expectations. This is below what we thought was going to happen. There's some publicized failures. You fall into what's called the trough of disillusionment, where basically people are like, this technology is overblown. It's crap. This is like, we don't even think this is valuable. It's going to die, right? We hear that. Have we heard this before? Have we heard this, sort of dichotomy before, where something's super overhyped and then people are like, it's crap, But during this period, you still have innovations being made on the initial technology. And this is what is called the slope of enlightenment. Slowly, people start coming back to the technology as the lower expectations are now being met by more fixed realities and increasing realities where the technology is offering more benefits. And you end in what's called the plateau of productivity, where the new technology has now been mainstreamed. It is matching what people expect it to be matching. People are now, the reality of what the technology is now basically conformed with public perception. How you can kind of see where this comes from is it comes from this observation that is made between the difference between human expectation and technological development. If you guys know what Moore's law, but I'll explain it. So Moore's law is basically it's an observation also. It's not like a law, but it's an observation that was made back in the 60s that had to do with the number of transistors on a semiconductor. And the number of transistors, it was noted, was doubling about every year, okay? That has since been revised to like 18 months to maybe 2 years. But the idea was that we're seeing a doubling of the number of transistors on semiconductors within the same space, the same size. And this was leading to the increase in computation. And the curve that you notice, if it doubles every time, is an exponential curve. So computation doesn't grow linearly, it grows exponentially. And this is not only true with computers, but is actually true with a lot of different innovations. There was a book written on this that was called The Law of Accelerated Returns by Ray Kurzweil. And he talked about how basically technologies compound on themselves. And when you initially get a new technological innovation, like a semiconductor or something, or you get some sort of, new way of, putting information onto a handheld device, it's a lot easier to move from that to a smartphone, and then from a smartphone to applications and to all these other things than it is to move from the initial point to the smartphone. it's the point is that the technology compounds on itself. So you see, instead of a linear growth in technology, it's a compounding growth. It's an exponential growth. And because people often think linearly, and there's a book on this that is called How to Create a Mind by the same guy, Ray Kurzweil. Ray Kurzweil talks about how people don't think exponentially. And actually, it's very hard for people to conceptualize exponential growth. People really only conceptualize things in a linear fashion. And you can think of this logically. Like, if somebody were to tell you that by 2026, the average cost, startup cost or upfront cost of an EV will be cheaper than the upfront cost of a combustion engine car. If you were to tell somebody that now, that's not as crazy. You know, people are like, okay, I see that EVs are becoming very popular. I see them all the time. But if you were to tell somebody that in 2016, they think you were insane. But people were making these predictions in 2016. But people didn't believe them. People were like, that's overhyped. That makes no sense. And why do people think that's overhyped? Because they look around them and they don't see the wide adoption of EVs. They don't see the wide adoption. So they're like, I don't see how it's going to get to such a high adoption rate within this short time frame, because I think linearly, and everybody does this. They want to see it, the linear projection. And because of that, you often see this overestimation of products, where you see this right here, the human expectation. When you think of like what the technology can achieve, you overestimate it early on. And this overestimation is what we see when we see the hype, you know, this inflated expectation. Then it falls into the trough of disillusion when these expectations aren't met. But then we slowly get back to reality as the human expectations begin to converge with the, you know, with the actual technological impact. But then that's when we see the underestimation. You know, we then in the future underestimate things. So what does that mean for anything that we do? It means everything for any sort of investment. Investment is very much hype driven, and hype will determine a lot of what the price action is on different investments. But I think that the issue, as you as an investor need to like break through on a lot of these like new innovative things, is you want to make sure that when everybody else is overestimating something, you see the reality of it. When everybody is underestimating something, you see the reality of it. So you are able to, instead of thinking linearly like the masses and falling for hype and then also falling for disillusion, you're able to think exponentially and see the potential of products in a more realistic manner. And Warren Buffett actually talks about this in his book, The Snowball. And you think about that, what does it mean for something to be a snowball? Why did Warren Buffett call his book The Snowball? A snowball is something that compounds. It gets bigger and bigger and bigger on itself. It becomes, and it grows and it compounds. So when Warren Buffett talks about investment, he talks about how you need to invest within exponential thinking. You need to think of things as a snowball effect, you know? So I think that basically sums up like the main points. And I know there's maybe some examples that you guys might want to get into. Just,
we did a video on this actually, how our brains can't conceptualize exponential growth. And I just want to add, Ray Kurzweil is one of the great minds in AI. So he would be a great author if you guys are into books. He talks about the singularity a lot.
A perfect example of this is crypto and AI. Like if you guys go back to 2017, you had these ICOs launching and everyone thought that everything was going to be tokenized like back then. And then once it didn't happen, and this was people overestimating it. Then once it didn't happen, people were like, oh, crypto's dead. But now like this recent bear market that we just kind of went through / are in, it's a weird bear market. You saw something different. In 2017, you heard about Goldman Sachs and all these large major financial institutions saying that they're going to have like Bitcoin products on their trading desks, you know, all types of different crypto products. They rolled them all back. But after the 2021 bull market came to an end, you actually saw these large companies, Walmart, Fidelity, filing for more patents and actually still building out their crypto initiatives. And now, you know, we're kind of getting close to the projections that people are, you know, hoping for. We have a Bitcoin ETF. We have like some of the largest, not some of the largest financial institutions in the world becoming a part of crypto. Same thing with AI. It's harder to predict where AI is on the spectrum, though, just because it's not like crypto to where like it's just different. Like you can't see all of the AI products.
Yeah, I think we're still in the hype phase.
Yeah, I think
for
you
AI.
chat GPT and everyone's thinking like, oh, AI could build a website. Like, and you see all these jokes like on your pitch deck, like who's your whole team, and it says chat GPT for every single position.
Yeah.
You know, and it was also the fastest app to reach 100 million users. So everyone thought like, oh, AI is about to take over everything. When I would say people have been working on AI. I can't even say people have been working on AI products longer than like cryptography, because cryptography goes back to the ancient Romans. So that is probably older than artificial intelligence, but it's just a good way to look at it. Like once people are like getting, it's not a bad idea to go against the idea that most of the masses have, because most of them are wrong, because they look at like mainstream media, which is designed to keep you in an ignorant state. So you just got to be able to look at it with your own brain. That's good stuff, Isaac.
So I think on Bitcoin, Isaac, let me ask you this. Can that chart be cycled? Meaning like, can that same cycle take place on one asset or one technology?
Yeah,
More
I was wondering that too, because I was thinking with AI specifically, AI has been overhyped in the past too. Like you got to think about the initial computers and expectations that people had for computers back when IBM, you know, was making all the mainframes and stuff back in the 50s and 60s. People thought back then that we would have AI, like that we would have like, you know, humanoid machines and all this other stuff. And we didn't get that. So then we got this brought down to reality sort of moment. And I don't know, I kind of am of the opinion that this thing can cycle through with different innovations, but maybe along the same, you know, technology.
Yes. So with Bitcoin, I would say we're still actually in a hype phase. Believe it or not, I would say that. At the end of the day, El Salvador made it a legal tender, bro. It's a horrible currency. If you actually had your minister of finance or whoever is looking through and making this decision ultimately, or letting you know like, hey, this is a good move or not, they definitely see that this doesn't make a great medium of exchange. And I think the only reason that they did that is because then obviously we were in a hype train. Well, it was in a bear market, but still hype train. And I think still we're overestimating, as it said on that chart, the capabilities or the eventual use case for Bitcoin, which ultimately it is going to be a store value like gold, I believe. But we're ascribing other things to it, like currency, the ordinals, and all this other stuff that we're trying to accomplish, but that it hasn't been sustained. And so I would say even on Bitcoin, we're still like not in the beginning of that overestimation phase, but we're getting close to the middle in which it'll start to shift.
I agree.
Yeah, I mean, I was kind of thinking about that too, because I was thinking like crypto is definitely still like in its infancy when it comes to use cases and all these other things that it could do. And I don't think we're quite at the point where crypto's true potential has been realized. In looking at the curve, you generally get to the underestimation point when you see a lot of growth in the actual application for the technology. And I don't know if we're like quite there yet. So I kind of concur in the sense that I think we still kind of are in the overvalue period, you know? So yeah.
We got to get you a shirt that says that. When that's your motto.
That's my motto?
Yeah, that's your motto.
Do people think this about me?
Oh man, that's a horrible motto. That's like
That's a terrible
motto, but like slogan or something. I don't know.
Okay. I'm like, man, he just concur with everything. That's horrible.
Oh wait, I concur. Did I say it?
Yeah.
Oh shoot! Wow.
You didn't even know you said it. That's
I explained why I concurred though. Like it's not like I'm talking out of my ass.
When you say it, it makes sense every time. It's not that you're just like spitting it out. It's just funny as well.
Yeah. What's a synonym for concur?
You must have heard it like on a show or read it a lot recently, because you're definitely going through a phase in which you're saying concur a lot.
I've always said concurred. People say
it's not a phase. Okay.
This is my first word.
Really?
Didn't care.
Oh, I got a new thing I'll say instead. I'm gonna say I'm in accord.
Oh my.
That's pretty good too.
Oh man. You got
No,
it.
that's good stuff, man. I just think it's funny. Well, guys, that is great stuff. Hopefully you guys got value from this. If you did, drop a like, drop a comment, subscribe. Let us know what you want us to cover next, what topics, what asset class, whatever. And we thank you guys for tuning in, and we'll see y'all on the next one.
Peace out.
Peace.
Peace.